talk about what happened in the market and the day before I'm speaking, so it's got to be kind of more timely information, but I'm also trying to relate it to what we say at these webinars. Okay, so there's a picture of Tony. You all know who he is. If you've not bothered yet, there's a good interview with Tony in FinTech Buzz magazine. It's worth reading. You can see all the things that Tony's working on. Okay, so let's get into it. We're starting off talking about the tradable rally that we're in now. If you all attended our October webinar, Tony said that we were in a tradable rally, and he couldn't have been more right, because since he said that, the market has gone up quite a bit. You can kind of see we didn't have the set webinar exactly at the low, but we're up about 6% from when Tony said it was a tradable rally. When Tony said it was a tradable rally, he said it for several reasons, and one of the things he said was, he cited a note written by Michael Wilson, Morgan Stanley's equity strategist. Michael Wilson has been correct on the market for most of the years, most of this year. So he has a big following. And of course, he was saying it was a tradable rally, and that turned out to be correct. But one of the interesting things about Mike Wilson's comments is one of the cornerstones of why he wrote it was a tradable rally in October was that he thought that there might be a positive surprise from the Fed at its November meeting. Oh, I forgot to mention, if you're looking at this slide right now, that's the QR code, and you can listen to Morgan Stanley's market podcasts using that QR code. So if you're not near your phone to download it now, these sets of slides will be available to you on our website soon enough. Okay, so as I said, Michael Wilson had expected a positive statement from the Fed at its November meeting, and in fact, it was the opposite. Jay Powell said that investors were getting ahead of themselves, and thoughts of a potential pause and tightening was going to be very premature. Actually, Wilson actually said maybe there'll be a pause. Okay, but the market went up anyhow. And also, if you think about it all year long, the market has been going down as bond yields go up. And during the month of October and into the beginning of November, bond yields were going up and the market was going up as well. So something changed a little bit, besides the fact that now over the last few days, bond yields have been dropping. And what changed is that the U.S. economy, that data from the economic data from the U.S. has been better than expected. Now, if you Google Atlanta Fed GDP now, you'll find that the Atlanta Fed has sort of this calculator. Now, they don't say that this calculator is a prediction of fourth quarter GDP, but what it is individual little pieces of data, like an employment data or last night's retail sales data come through. They plug it into this GDP now, and it projects what U.S. GDP's got to be for the fourth quarter. So you can see that from September, October, and now into November, and actually this just got updated yesterday, it's now showing like 4.2% annualized growth for the U.S. in the fourth quarter. So what this is not saying is that the U.S. will grow at a 4.2% rate in the fourth quarter. What it's saying is the numbers that have come out so far indicate a 4.2% growth rate. And most economists think growth rate for the fourth quarter has got to be less than 1%. But the message here is that the numbers are coming out much better than expected. So you have two things kind of going on right now. You have that are really giving the market a boost. And the first thing is that you got a better than expected GDP, but at the same time, inflation data is moving lower. So you have, here's the year-on-year, this is the way most people look at it, year-on-year CPI data. This is the headline number. And as you can see, it peaked back in June and it's been going down. We had a couple of numbers that were a little higher than expected. The last number was a little bit lower expected. So you have this combination of better than expected economy, and of course a bad economy means lower earnings, but you also have reducing inflation, which means that the Fed is not reacting to that stronger expected economy by saying that we're going to have to raise interest rates, or they're going to have to raise interest rates more and more. And in fact, after the last CPI number that came up, the futures market started lowering expectations for how much the Fed would hike rates, and also started showing that the Fed will hit the peak rate in March instead of July where it was before. So basically, we have a little bit of a stronger economy than expected. You have inflation coming down a little more quickly than expected. And you have the market assuming that the Fed isn't going to raise quite so high, and it's going to finish raising rates a little several months sooner than previously expected. You throw that all together and it becomes very bullish. Okay, also, then the key question is, will inflation continue to drop? Well, here's a very strong reason to believe that we'll have big drops in inflation going forward, because even in those better than expected inflation numbers that we just had, we had one of the large sub-indexes in the CPI, the shelter sub-index, which is a combination of rents and the cost of owning a home stuck together, called shelter. You can see on this chart here, that's going through the roof. So CPI was going down even though this was going through the roof. And the reason that means that we're going to have lower inflation going forward is because this particular part of the CPI is very laggy. It doesn't really react in real time to what we know what's going on. So we have information on rents from sources like apartments.com. We have information on the prices of housing from places like Zillow. And between those two things, we know that shelter inflation is actually deflating. Prices are actually dropping. But because of the index being lagging, and that has to do mainly because people sign one-year leases. So if you imagine you signed a lease last year at a low price, and that lease is expiring in December, you're going to re-sign that lease at a much higher price, and that's going to feed into that inflation data. And the inflation data doesn't say, well, hey, the price you're signing in December is lower than the price you would have signed on as if you had redone your lease in November. It just looks at the increase in price. So anyhow, that was a simple explanation of the way it works. But eventually, all these leases will be redone. All this stuff that makes this data lagging will be done. And actually, this will become a force of deflation. And so even though other things like labor and other parts of the U.S. economy will be having inflation, this very big part of the CPI data will be canceling it out with deflation. Here's an easier way to see what I was just saying with energy, which is, of course, part of headline inflation. You have, here we are in November. Well, the current price of oil in the United States, when we're using that as a proxy for energy and gasoline and everything else, is 31% higher than it was last year. So if you're doing that year-on-year thing, it's 31% higher. But then in December, it'll only be 15% higher. By January, it'll be roughly the same price. And going into February and March, oil prices will be lower than they were the year before. That's assuming that that oil stays around the current price. But you see what I'm getting here? All these things are going to be driving down that CPI, and that will make the Fed feel like they've gotten their job done, and that will mean that they're not going to be raising rates so much, and that is very bullish for the market. The flip side of this, of course, is what I started off saying with bond yields dropping over the last few days, is that people are expecting a recession in the U.S., which, of course, is not good for markets. I'll touch on that in a little bit. But also, you can see here, instead of looking at year-on-year data, you can see if you look at the inflation data, this time using the PCE, quarter-on-quarter, you can see how inflation on a quarter-on-quarter is already much lower than it was at its peak. It's down to 4. So it's very easy to imagine that not too long in the future, the Fed would have gotten inflation down below its 2% target. We'll see how that goes, but you can see there's more and more a sense that the Fed is being successful at its job. Okay, since I touched on energy a minute ago, I just wanted to touch on energy now. This is more about investments than all this economy stuff I was talking about before. If you had any energy stocks in your portfolio this year, almost certainly those were the best stocks you owned, because the energy sector is up like 70% this year. And of course, the stock market is down. So what does that mean? And always when you're in a bull bear market like this and you have this one good thing that's helping you out, you're very loath to sell it. But I just wanted to kind of put what energy's done in perspective here. So the other day I was listening to the strategist from Morningstar. I was listening to him on television, and he pointed out at this time last year, Morningstar rates all the different U.S. sectors. And at this time last year, they rated energy as the cheapest sector using their fair value calculations. And of course, what happened was that the price of oil went up a lot, natural gas went up a lot, energy company earnings went up a lot because of the higher prices for oil and natural gas. And of course, the stocks went up. But that doesn't explain all the appreciating the stocks. The sector also got re-rated because people liked it, because it was going up and in a bad year, so people were buying it. So now Morningstar has energy among the sectors with the highest price per fair value. So instead of being this bargain sector, it's kind of an unbargained sector. So in order for energy stocks to keep going up, what you're going to need is oil and natural gas prices to keep going up. So how does that stand right now? Well, one thing that I'm a little bit optimistic about, doesn't mean that I expect them to have peace, but I think that you're going to hear very soon that Ukraine and Russia are going to go back to the table for peace talks. So that's probably a slight negative for the energy market. Not that big a deal, but probably a slight negative. Then if you look at the supply and demand situation for oil, well, it's very, very tight, okay? So what does that mean if the oil demand situation is tight? Does that mean the price is going to go up? Well, usually it doesn't. What it usually means is that the market, when it's tight, that's kind of when you want to sell, because if it's tight, the next thing is more often that they find extra supplies of oil and get it to market, then it actually becomes tighter. So because it's tight, there's chances for spikes in the oil price. Our advice would be to sell your oil shares if you have those kind of spikes. Our advice is to sell on rallies. And our kind of long-term view is that oil prices are going to trend down during the year. Okay, here's another thing that makes you say, well, maybe energy companies should be priced a little bit on the cheap side. This is just really the impact of EVs on the oil market. And you could see, if you look at this chart here, which is from the International Energy Agency's data, it's not a big deal this year and next year. So there's no big impacts on the oil supply and demand due to EVs right now. But before this decade ends, you're going to start seeing a true decline in oil demand just due to the switch from cars burning gasoline to cars running on electricity. And by the time you get 20 years forward, it's got to be a big chunk of oil demand's got to be reduced. And I wanted to remind you again, we're using the Paris-based IEA data for this, and that data is very conservative. You can go out and find people who really believe in EVs and green energy, and it's much more dramatic than this. So, okay, if oil demand goes down, who's it going to hit? It's going to hit the big oil companies, because the big oil companies, they're experts at getting that expensive oil, while the state oil companies, they kind of get the cheap oil. I mean, Saudi Arabia would, of course, be the champion of the cheap oil. It only costs them about $5 in variable cost to get that oil out of the ground, compared to what Exxon and Chevron pay when they're doing their projects. So if you look at the world, the big oil companies, right, they produce, about 18 million barrels a day. The 17 million barrels a day. The state oil companies produce a lot more. So but when they start reducing demand, it'll be the high cost big oil company oil. That's the one. Those are the guys who'll get squeezed out of the market. So none of these energy companies are going away anytime soon. But if you're thinking about the way they should be valued on the cheap side, because their long-term prospects just aren't that good. Okay. Since I just mentioned Morningstar saying that energy companies last year were the cheapest, this year they're flagging the communication stocks in the U.S. as being very cheap, so using their fair value calculation. So let's take a look. So now we're going to just take a look at a bunch of those communication stocks. And just remember, those aren't telephone companies anymore. That's Facebook, that's Google, that's Netflix. And let's see how they compare to other companies. And I purposely took other companies to compare them to that have nothing to do with that communication sector. Okay, first, just pointing you out, if you just wanted to buy the communication sector, here's the ETF, the XLC. You can buy the communication sector ETF. And you can see that even though its share price, that the largest exposure in that is Google Alphabet, which is about 23% of the ETF, and then followed by Facebook Meta. Okay, so the first communication, we're going to talk about Netflix and Chill. And the reason we're saying that, we're being a little cute here, we're going to compare Netflix to Pepsi, which of course makes Frito-Lay potato chips. So let's just talk about the big picture for those stocks. Netflix, it has to compete for new subscribers to their service now. It's getting very competitive with Disney and Paramount and HBO Plus. So they're spending a lot of money on content creation. That's a negative for Netflix. On top of that, of course, they're having, just because so many people have it already, there's a natural slowdown in subscriber growth for Netflix. On the other hand, Pepsi's a pretty simple company to understand. And what we learned about it this year is that it doesn't get hurt by inflation. They're able to just raise their prices and pass it on. People aren't going to stop drinking their soft drinks and eating their potato chips just because the price went up a little bit. So basically, in terms of what's going on this year, everything favors Pepsi. So now let's see, you can see it here. Pepsi's one of those few stocks that are up this year. And of course, Netflix is down by about half. This is a little old, but yeah, it should be roughly where they are now. And so does Pepsi, because it's up and Netflix down about half, does Pepsi look to be more expensive than Netflix? Well, just take a look at these numbers now. I don't think it does. I'm going to do a little drawing here. It's been a while since I've done some drawing. It's a cheaper PE for Pepsi. Netflix, of course, historically traded at a very high PE, and now it makes money. So this sort of flatters Netflix. Earnings growth, because you think of Netflix as an earnings growth company, but because they're spending so much on content, they're actually not growing their earnings as quick. This favors Pepsi. And revenue growth, that should be where Netflix wins. They're going to be helped a little bit this year because they're going to do the advertisements. That'll give them some additional revenue. But look, it's pretty comparable. So if you put all this together and you figure this is a safer business, actually, even though Pepsi's outperformed, things still sort of, favor Pepsi. So let's, let's go on to the next one. Okay, so we got Netflix and chill. Now we're imagining we're at a Starbucks and you're by yourself and you're checking out your Facebook page. So we'll compare Facebook Meta to Starbucks. Well, in terms of key drivers, we all know that Meta has been a terrible stock this year, so it's not surprising its key drivers are bad. They're spending a bunch on the metaverse, and people wonder whether that's money well spent. And obviously, it suffers from a slowdown in advertising, right? And that's due to the slowing U.S. economy. Even though I started off by saying the numbers are better than expected, of course, we're expecting a recession. Also, companies like Meta and Google, they were getting a lot of ads from cryptocurrency firms, from mortgage companies, these companies that have been really hurt recently for various reasons, like mortgage refinancing due to the higher interest rates. So their advertising is down. Starbucks, of course, has not been doing that great either. They have labor issues. And of course, they've had a hard time in China because of all the lockdowns, but that's changing. So we made that a thumbs up. So things are going a little bit better for Starbucks. So let's look at the numbers. And here it's a different story. So even though the story for Starbucks is a little bit better, Starbucks still looks expensive. Netflix looks very cheap. It's been a bad stock, but it looks cheap. Historic PE, they're both way below their historic PE, but much more for Facebook. Earnings growth, of course, Starbucks winning. Revenue growth, Starbucks winning. But if you compare the PEs, okay, I think Meta's definitely the winner. Now imagine you're going to Disney World and you're booking your hotel and your airline tickets on booking.com. How does that work out? Well, in terms of key drivers, good old Disney has the same problem as Netflix. They have to spend a lot of money on content. That's a big negative. But the theme parks are full. In fact, they're so full, people are quite annoyed, right? They've raised the prices. They've become expensive. And of course, this year, they kind of got hurt. They didn't have as many theatrical releases, but they got Wakanda Forever, so we'll give it a thumbs up. And next year, they should have a lot more theatrical releases, so that's a positive. Booking.com, it has booming economy, but it also has recession worries. So if you kind of look at it this way, both of these companies actually are different from the ones we had before. You know, both of them look kind of okay in terms of their key drivers. Disney is down more this year. If you look at the PEs, it favors Booking, but you got to remember, Booking's like an internet company, you know, it doesn't really have much, whereas Disney has all these amazing hard assets and amazing soft assets, you know, like intangible assets like, you know, Mickey Mouse, etc. And all. So basically, in terms of PE, I would say, you know, this looks better than this. Now, because both of these guys were totally whacked by COVID, this is sort of meaningless. Earnings growth, comparable. Revenue growth, comparable favors this guy a tiny bit, and you're getting him at a lower PE. So the moral of the story of this one, I think it favors Disney, but they both kind of look good, right? Maybe, but definitely Disney, I would put that down as the winner of this exciting contest. So here's the last one on the list. I had to stretch for this one. As you know, Alphabet has a product called Google Nest that you can use it to control your house. And then I matched that up with Home Depot, which is, of course, a retailer. If you look at the key drivers, right, you know, you don't need to have a new house to want to go buy stuff at Home Depot. It's really fun shopping there, and you could use it for home improvement for the house you already own. But of course, people spend a lot more on their houses right after they bought it. So the fact that, you know, property sales are really down because of the high mortgage rates, that's a negative for Home Depot. Of course, they just came out with their earnings. It showed they're doing a good job anyhow. And the fact that mortgage rates seem to peak, well, that's sort of a sign that maybe home sales are going to pick up. So you got a nice positive there for Home Depot. Alphabet, Google, you have ad revenue down. That's definitely slower economy. And like I said, things like mortgage refinancing, things like cryptocurrency, all those ads have gone away. The cloud segment is not a big P&L segment for Alphabet, but that is something they're working on very hard, and it is growing. So it is definitely, their last earnings indicated that it was doing better than expected. So that is a positive there. If you look at the performances of the stocks, not too different compared to the other ones. Google down a little bit more. PEs are comparable. Home Depot trading quite a bit cheaper. I mean, you can kind of imagine Google's like a thing you can't live without, so probably justifies a little bit higher PE there. If you look at earnings growth, this looks excellent. If you look at revenue growth, this looks evident thing. So if you kind of put all this stuff together, you know, it may favor Alphabet, but not by too much. You know, they're pretty comparable companies, but you know, I would definitely favor the Google Alphabet. So now we've gone through all these stocks, and I'm going to turn things over for a second to my colleague Aiden Ng, who is going to talk about structured products, just because a lot of you don't have, you know, you don't hear about them so often, and I just talked about a bunch of stocks, and he has some examples here about different kinds of structured products that exist and how you can use them on different underlying securities.
Thank you, Paul. So, hi everyone, this is Aiden. I'm from UoB Kay-Hian Products Desk. And today I'm here just to share some of the products out there which can help you in your investment or trading. Yeah. So typically a client when you know, looking at the market would then think about whether they should simply just buy and then hold it. And but that is not the only strategy. So we have this category of products, well, generally speaking, termed structured products, and they have been very popular among private banking and privileged banking customers. So as the name suggests, these are typically tailor-made solutions meant to capture a specific investment idea or strategy, so that now you no longer simply just wait for the right entry point, buy the stock, and then wait to get out again. So there are many forms of structured products, and there are many fanciful names given by the banks. You may have heard ELNs, fixed coupon notes, step-down auto-callable, Phoenix, etc. But in short, all these products, they can be generally grouped into 4 different categories, right? In terms of risk, so the first category, principal protected, and then your yield enhancement and your participation, and finally, the one with the highest risk, a leverage note. Yep. Yeah. So let's go through them. The first one, principal protected notes. The key consideration here for the investor is capital preservation. Okay, these are usually based on less volatile assets. For example, bond fund, indexes, since they are less volatile versus individual stocks. They provide, there are 2 forms. In the purest form, they provide full protection. That is, for an investor, you basically guarantee you will receive back 100% of your capital. The downside is perhaps you won't make, but at least you get back 100% of your principal. Do remember that low risk, low return. So if you are looking at such a product, your expectation is not to make big bucks. All right. And a second form would be a partial protection. In such,
Yep.
In this category, you actually risk a small portion of your capital in return to make a higher a profit opportunity. Thanks. The next one, please. Yeah. The second category is what we call yield enhanced notes. These are very popular among investors who choose to, not to go for capital gains, but more for dividend income. Yeah. So this, so they are higher risk versus your principal protected. They are especially good for sideways market. Now, I mean, as investors, right? Imagine you are trying to time a market, right? As what Paul has mentioned earlier, some of the stocks, they look attractive, but at the back of your mind, you know that some of those stocks, they have been up for the past 2 weeks. So what's your strategy now? Do you then wait for the stocks to drop and then you enter the market to buy? Well, if that is what you are thinking, then basically your money is sitting in your bank account doing nothing for this period, and you never know whether the stock price will actually fall, right? So to make your money work harder, most people, a lot of the private banking, privileged banking customers, they choose this product instead. So this product actually locks in your strategy. If the stock falls, you get to buy the stock at a cheaper price. While you are waiting, you are earning a yield, and the yield is generally higher than what the stock pays in dividend. So typically 10 to 20% depending on the stock. A tenure maybe 6 months to a year. Yeah. So I included a small table underneath. Yeah. If you can look at this, this is just a short 3 months note, and the underlying is Disney and Alphabet. Right, you are getting a coupon of 12% per annum. Yeah, but of course, if you hold it for 3 months, then you get 25% of that only. Yeah. So this is what it means. Basically, you sit on it, you wait. If the stock falls, in this case, the strike level is at 66.3. So if the stock falls like 35%, yeah, you would buy the stock 35% below today's price. If that didn't happen, then you earn the coupon 12% per annum. Right. The next one is a participation note. These are for clients who are more bullish or more bearish, depending on your on your view. And well, you can even go sideways. For example, at this moment, we are not so sure whether the stock will be going higher or lower, right? So this note actually allows you to make money so long the stock move either way, right? If it goes higher, you make the performance. If it goes lower, although the performance is negative, you will still make a positive return, right? And yeah, so in this case, again, the table, in this case is a 6 months example on Zoom. Yep, a communication stock, as what mentioned by Paul earlier. Yep. It pays a conditional coupon of 35%, right? So in 6 months time, yep, if the stock rises above 10%, it get early redeem. You receive conditional coupon of 35% per annum, right? Again, it's per annum, but if you hold it for 6 months, that is what, almost 17% we are talking about here. Yep. And on the downside, should the stock fall, say 20%, you actually make 20% return. And you'll continue to make that 20, if the stock falls 20, 30, 40%, you will make 20, 30, 40, even though the stock has fallen, right? So the only risk comes if the stock falls more than 50%. And that is where you start, that is when you will start to worry about your position. You may end up receiving shares. Okay, this the last category is the highest risk. These are leverage notes. These are for people who are really strong in a view, be it a long or a short. And yeah, basically these are just option playing, and you are using a small capital hoping to make several times return. These are the highest risk, something which I wouldn't recommend unless you're a very seasoned investor. Yeah, as mentioned there, if the stock has a 2 times leverage, basically should the stock goes against you, a 50% drop will wipe out your position. Yeah. So finally, this is the final slide I have. Yeah, so structured products, as the name suggests, they are tailor-made solutions, okay? So because they are tailor-made, anything is possible. It is possible to combine various features. For example, I have here a twin win. If you remember earlier, this fall under the category 3 participation note, and then plus a principal protection, right? So you get to benefit. So if the stock moves either way from today's point, today's price, whether it's up or it's down, you will still make money. And should it swing more than what the barriers indicated there, you actually receive back your principal. So there's no loss to your principal, and yet you make money if the stock is up or down. So kind of fantastic, but of course, these are various products offered by the bank. UoB Kay Hian we do have, and we work with several banks to provide you with the best pricing or parameters. Yeah. So if you're interested in this, please contact your dealer, or you can drop us an email at products@uobkhian.com. Do note that these are complex investment products, and according to MAS, they are not suitable for everyone. Investors or interested clients would need to be qualified, right? So by qualification, it means, you know, accredited investors or persons with relevant knowledge. And these are big ticket item. So every trade will be like 200,000 to 300,000. Yeah. Yep. So back to Paul.
Okay. So now we're okay. Now I began the presentation talking about why Tony's tradable rally occurred. We had relatively good news on the inflation front. We had relatively good news on the economy front. So even though the Fed said oh, we're not going to pause, the market liked it because the good economy sort of compensated for the not pausing. And then on top of that, okay, on top of that, the good news on inflation means that people think, okay, well, maybe the Fed's not going to pause, but they're going to finish up a little sooner than we previously thought. So all good. That's why the market went up. But of course, it's already gone up, and it kind of makes sense. We're going to consolidate a little bit. But once we've consolidated a little bit, we're got to, my view is that we're headed to a Christmas rally. And of course, if you're looking at it, it always seems to me that going into the end of December, we always have a rally. But my colleague here, Jeffrey, he got very scientific, and he said we should explain what a Christmas rally is. And the Christmas rally is not a rally that occurs going into Christmas. It basically occurs right around Christmas and into the end of the year and the first few days in January. So that's when we have the rally. And the question Jeffrey asked was, okay, well, if we have it every year, do we have it when we're in bear markets? And the answer is most of the time we have Christmas rallies even during bear markets. So pretty much we're set up with a positive frame of mind in the U.S. We just had a surge forward. It makes sense that we're going to consolidate a little bit here. This is all good questions to ask Tony about. But once we've consolidated, we're expecting Santa Claus to come and to finish with a good year end. Maybe we'll get back to where the S&P is only down about 10% for the year. That would be a little bit optimistic, but it could happen. Okay, we're going to finish up here by talking about the famous Fangman stocks. I just put this slide in. It'll be on the website. You can look at it. You can on your own just to sort of recap. And now we're going to go into, I started last year giving my rankings of the Fangman. And I thought, well, maybe I wouldn't do it so long because I'd be horribly wrong. But I've been pretty much correct. I haven't been perfect, but I've been significantly more right than wrong. So how am I doing with my new picks of my Fangman ranking since October? Well, what's what I said in October. I put in my favorites. I said there were quite a few reasons to be negative on Apple, but there was no way that I was going to be bearish on Apple going into the Christmas shopping season. And I think I was correct on that. Apple has been a pretty decent performer, up 8.6%. Google, we just went through their numbers. I like their numbers. They obviously got hit a little bit by reduction in ad spending, but at least they're up. And I had shifted NVIDIA, just saying this stock had just gotten so beat up, it looked so cheap relative to what it traded at before. I just moved it into the favorites. So you put all three of those picks together, and on average, since I recommended them 1 month ago, they're up 20%. So I'm back on track as recommending the right thing, because that's definitely, those were the best stocks. If you looked at my middle stocks, they pretty much are middle stocks. Microsoft obviously outperformed Google. And you go to my least favorites, well, I put in Amazon as my least favorite. I don't like, I think the e-commerce business has got to be under some pressure. They're still got to be facing labor problems, not necessarily union problems, which they have a tiny bit of that, but just they're going to have to pay more for labor. The only thing that continues to go well for them is a big deal, which is the cloud. So they're down there in the least favorite. And what I got wrong is putting in my least favorite is Netflix. But of course, we just did that comparison of Netflix to Pepsi. I'm still not very excited about Netflix. So I think it's in a very tough business right now. All these streaming companies are trying to produce a lot of good content. So now we have finished, and we're going into the question section right now. And yes, we have a lot of questions. Okay. First question. Okay, Tony can try this one, because at first I thought it was a China question. But then actually the person is asking is, will China opening up, will that affect inflation numbers in the United States?
I think, I don't think so. I mean, but yeah, I mean, when you say inflation numbers, meaning reduce inflation in the United States, I think the answer is yes. I mean, across the board, any reduction, any improvement in supply chains is always going to benefit reduce cost. I mean, have more of a deflationary impact. So I would say yes to that. But that's mitigated by other concerns that continue to be on the stage as it relates to China relations with the U.S. and other Western countries. So to see how that balances, but standing on its own, of course, opening up of markets is always going to have a deflationary impact.
Okay, so I hope that's the answer you wanted. The next question is, will the U.S. experience recession next year? Is that the base case for investing? That's a two-part question, and I'm going to answer it, but I'll let Tony give his view. Like right out of the blocks, the Fed has raised rates enormously. It would be just a shock that they could raise rates so quickly, so much, and there not being a recession afterwards. So definitely, given that the economic numbers that we're getting from the U.S. right now are positive, we're definitely not going to have a recession this year. So it's going to be probably in the next 12 months. It'll probably be next year, middle of next year, it should start. The other inflation indicator, of course, is the inverted yield curve. We have the yield curve inverted from the 3-month to the 10-year. It's heavily inverted. Yesterday, for a very short period of time, it was the most inverted it had been since like the 1980s. But anyhow, I diverged the thing. The 3-month for the 10-year is almost a perfect predictor of a recession in the next 12 months. So basically bet on a recession. But when you say it's a base case, it doesn't necessarily mean that you should be panicked, because if you think about a company, it's not really thinking, oh, this quarter we had 1% positive growth. Next quarter we had a 0.5% negative growth. These things kind of, they don't operate so much quarter to quarter, right? And the things sort of average out for them. So if we have growth this quarter and we have growth in the first quarter of next year, and things start to shrink in the second and third quarter of 2023, on average, you're going to have poor growth, but on average, you might actually, for the period, actually have some growth. Or if it's negative, it'll be very small. So even though you say, oh, we're having a recession, and it might be a true recession with 1 quarter of, truly, serious negative growth, it doesn't necessarily mean that, that earnings and everything are going to go into the toilet. Okay, I'll let Tony pick up on that question.
I mean, the market's down in anticipation of a recession. So if it hits, that's a buy, because now it's behind us. I mean, so it's this concern of how bad the recession is that's caused the market to be down what it's been down. The market will start rising, in my opinion, if these things become clear, and You move from concern about something to seeing what it actually is. The market, once it sees it, understands it, it tends to discount it, and I think, quite frankly, would be the market would actually start rising in the face of that recession on a broad basis, right? So right now, the big fear is how deep the recession is. All this kind of talk. I have to be honest. When people say, "Is the market going into a recession?" I don't know what that means, because what is it you're looking for in the recession that's going to cause you to have concerns about stock valuations? Is the more relevant question. What is it that we're looking for? Are we looking for consumers to pull back, to start losing their jobs, et cetera, et cetera, et cetera? Or is it something else? I mean, recession is just a broad term. So again, my view is, we've seen the floor back in June in terms of this market. This market wants to rise. The inflation, let's get it behind us. Let's have it so that we can move on from there. And I think, I think we're closer to the end of this bear market by far than the beginning of it, because we're worried that we're going to have a recession next year. I think that worry is already reflected in stock prices.
Right, and that kind of segues into the next question. The person said, he said, "Well, thank you for predicting that the bear market would end between October and December." Yeah, that's basically what we're saying. We wish we could have been more precise and said, markets would start rising exactly in October, but, that's, of course, impossible to do. But we also said, because the big gains start at the beginning of the recovery from the bottom, you did want to start buying stocks in October. So hopefully a few of you did that. The second part of the question part is, should he stick with the FANG stocks? Because, he has other people recommending to him mid and small cap stocks over the FANG. So Tony and I haven't ever discussed this, so I don't know what Tony's got to say. So I'll say my bit. I like the mid and small caps when I think that the U.S. dollar is going to strengthen. Since I don't really see the U.S. dollar, I kind of think that this weakening of the dollar is going to continue for at least a little bit longer. I would stick with the FANG stocks. But over the longer term, right, the person who's telling you to look at the mid and small is correct. Over the long term, you're going to get a better return with smaller stocks. Now, that doesn't mean you actually have to buy mid caps. It doesn't really mean you have to buy small caps, but those are very easy to buy through the ETFs, right? But basically, these giant mega cap stocks will probably start, as the market begins to rally up more and more, these stocks will begin to underperform. And I have to admit, we are a brokerage firm, so we tend to talk about the stocks that you guys like buying. And so we have a natural tendency to speak about the really large cap stocks the most, because those are the most popular with our clients. But there's nothing wrong with buying smaller cap stocks. And like I said, there's several ETFs you can do it with. Tony?
Yeah, I mean, like in any recovery phase, once we get to it, the areas that have been underperforming the most are the ones that are going to outperform. So FANG will likely outperform once people stop worrying about inflation, they see it, and see it's not going to be as bad as they thought it was. The things that will outperform will be things like technology. I don't want to say FANG. Technology. Small cap has been doing quite well. I mean, I think, but again, I would make it, if you're going to have it as a part of your portfolio, it's prudent. And the other thing that most people don't realize is, when you look at like an ETF like IWN, which is, the broad-based Russell 2000 small cap, that ETF is used quite a bit as a hedge by institutions on the short side. I mean, they short as a hedge against the larger cap part of their portfolio. So the unwind of that short can also give you an extra upside element as we move into a recovery phase. So, I think the best way to say it is, guys, the next phase is recovery. Okay, it's not. We've already had the bear market. We've already had, a number of these issues, barring, extension of the war in Europe or something happening in Asia, with Taiwan. In other words, these extraneous events. The next phase of this market is recovery, and things like small cap, like I said, the unwind of the short hedge that it's used as is an example, but also just the nature of small cap. Technology, which is the most underperforming sector of the S&P, et cetera, all of those will be the ones that are going to outperform the broader market. It's just, it's just the nature of the market. So the only question is when does recovery begin? And barring extraneous events, that to me has begun, but you're going to see it probably accelerating into 2023. And remember, again, I keep referring to a chart that we showed you periodically. It's very, very, very rare that you have 2 years in a row of negative returns. Very rare, okay? And, I would say, with the split Congress here, there's lots of reasons to think that the recovery phase, the beginnings of it, the very beginnings of it has already started in October.
Right. So at least let's see if Tony agrees with my base case is we've just had a big move. We might consolidate, and then, but once we get into December, we probably start moving up again, and maybe the consolidation doesn't last really much more than a week or so. Do you agree with that, or are you just full on bullish right now?
Well, I think no, I'm not. Well, I've been, personally, well, let me just say this. I'm not saying to go crazy here. I'm just saying right now I am more long than I've been in pretty much for the whole year. I do think you're going to have a consolidation here. There's lots of realized losses that can be offset with gains. I think people are going to take profits, particularly given the magnitude of moves. Just a few days ago, you had a huge move in some of these stocks, 3% in the S&P. People are going to use those to take gains. There will be some consolidation, but the things you pointed out, Paul, in terms of your slides, where inflation is going, those things are very much on everyone's mind. If there's 3 legs to this bear market, the concern about the Fed, how aggressive they're going to be, the concern about Europe, the concerns about Taiwan. The first one of those I think you addressed very well, in the sense that the trend is in our favor. So I think that people start stepping away there, that's going to let them be a little bit more aggressive. The other 2 are just unknowns, but perhaps things are going to get better, hopefully. So I think all I can say is the elements are there for the recovery phase to present itself even more. It's becoming, it's much more, the odds are in favor of that than we're going to have a second bear market here, if you want to think of it from that perspective. I feel I'm finding myself to play the odds here, right? The probabilities are that the 2023 are going to be better than 2022, barring extraneous events at the political level around the world.
Okay. Next question is, when is Tony coming to Singapore?
I'd like to come as soon as I can. It's certainly in the beginning of the new year.
Okay. The next question of that is, someone asked, is NVIDIA still considered cheap to buy at the moment? Well, it's up a bunch, but I'm going to have to punt on that because they came out with, I've been kind of busy, and they came out with earnings last night, and all I know is that the earnings were good. And so I haven't really had a chance to see how good or what that really means. The takeaways that you get from good earnings is that the company has not been overly hurt by the kind of the crash of the cryptocurrency markets. Of course, Bitcoin hasn't really crashed that much, but of course, these cryptocurrency, all these other cryptocurrencies have really collapsed, and that's, that was a significant source of business for NVIDIA. So that is a big positive for the firm, that they had a good result, even though that one business item is obviously not doing so well right now. So I don't know, Tony, do you have just any kind of off the top of your head thing on the NVIDIA results?
I mean, yeah, I think what you said sums up the result, that it's not as bad as they thought. Right? NVIDIA is not cheap. Let's be clear. But what you're buying in NVIDIA is innovation, right? You're buying the patent portfolio, things. They are a very innovative company. And so again, it's going to do well as a stock because people see it as that. It's the top AI chip manufacturer, et cetera, et cetera. So where industry technology is going, they have the product set to meet that, data centers, et cetera. So you're buying, a company that's at the cutting edge, but it's not a cheap stock. I mean, if you want, Buffett bought a bunch of Taiwan Semi. I think that's a prudent place to think about buying that stock, TSM, if you want cheap, okay? Because the only thing that's keeping Taiwan Semi down at these levels is, again, concerns about political concerns, right? So they are looking to expand. They're setting up their second fab in the U.S. They're probably going to set up fabs in Europe. I think you're going to see Taiwan Semi continue to diversify its global footprint. I think that will then help with its valuation. So if you're looking for cheap value play over a long period of time, they're the best. NVIDIA does not manufacture, okay, just to be clear. They need someone like Taiwan Semi to build those chips. So anyway, if you want cheap, something like Taiwan Semi, but if you want the innovator, the one who owns the intellectual property related to those chips, that's someone like NVIDIA. Two different places in the value spectrum now.
Okay. So in general terms, someone's asking will tech outperform energy and financial sectors this year? And my quickie answer is, after this huge move in the energy sector, I'm not very excited about energy stocks right now. Financial does not look expensive. So if there's a strong market this year, of course, financial stocks are going to underperform. But sometimes you shouldn't really worry whether they're going to outperform or underperform. You can just say it's okay to have them in their portfolio. But I would not expect them to outperform. The tech sector, that's where things were beat up. But of course, it's the communication sector that's beat up the most. So I would be more gravitating towards the communication sector than the tech sector.
Yeah, again, this year is over. I mean, was the question about this year or next year?
Yeah, no, next year. I'm sorry.
I'm in a recovery phase. Technology is going to do well. I don't know what to say. It's the if you just look at the market, it seems there's a consistent trend. The things that did the worst in the previous year are the ones who tend to do very well in the subsequent year. That's the best. There's an historical fact pattern there, and I think it's one that should not be ignored.
Okay. The next question was about the midterms and the Republicans controlling the House, the Democrats controlling the Senate. I had said before, this is the most bullish result, because if the Republicans had won both chambers, they would have had among their base, there would have been a lot of pressure to impeach Biden on something, and it would have been a big distraction. This way, they won't bother to try, and it's the same result. Even if Republicans control both the House and the Senate, if they tried to pass any legislation Biden didn't like, he would always veto it. So you have gridlock, and just like, in the UK, when they pulled back from their big tax cuts and all their spending on helping, it's sad to make it sound like it's a bad thing, but, helping people pay their energy bills. When they decided not to do that, it was very positive for the market. Same thing for the U.S. market right now. Not doing anything is a positive for the market. So that's the result of the election. The only other little tidbit I can say is the Republican majority in the House is going to be so razor small that a small number of Republicans can hold up doing things like raising the budget ceiling. And that's what's happened in the past. Now, the market has sort of gotten used to it, but that is something to expect, that you're going to have these little budget crisis, default risks, whatever you want to call it, periodically over the next 2 years, because that's what's happened in the past. That's what happened when Boehner was Speaker of the House. He had a hard time controlling the Tea Party members, and you had all these things happen. Tony, do you have anything else to say?
Yeah, I think it's the best result as well. It's the only, my preference is they all go home for a year and don't speak, but this is the best we can get. The closest to that is where you have gridlock. And yes, look at, everyone knows when on these calls, I'm not a fan of the whole political way we do politics around the world, but at the end of the day, gridlock I think is good. I think, quite frankly, it's deflationary. It's going to help with getting inflation down. And I hope they don't use it to play personal vendettas and all the other stupidity that takes place with my view, children who run governments.
Okay. The next question is, what's the view of Tesla? It's still on the expensive side. I think Charlie Munger said in an interview yesterday, what Tesla has accomplished is I think he used the word, a minor miracle. I think that's an understatement. It's more than a miracle, but the market still puts a big valuation on Tesla. I don't think it's a problem for Tesla that Elon Musk is involved with Twitter. I don't think that's really a problem. But I think the problem is that the EV business is just going to be getting more and more competitive. So, I think that the huge valuation of Tesla is just not justified. Having said that, it's cheaper than it's been for a long time. Okay, someone wants the name of small cap ETFs. That's easy enough. Belinda, just give me that person's email address and I'll just send them a list of a few. Okay, and then let's see. Someone's asking a specific question about Salesforce, which is not a company that I read about very often, so I'm afraid I can't answer it. So I really, I'd be tempted to say something nice about Salesforce, but then I'm just really talking without, any kind of grounded information, so I'll avoid that. And that concludes all our questions. let's another person had a question that they had some confusion on a few of the points because there was so much content. And yeah, I have a tendency to do that, so I'll try to improve my presentation. But if that person can just send an email, Belinda will give you the thing that I'll try to write back an email with a little bit of clarification. So I'm going to give the address system back to Belinda, and she can say goodnight to all of you. Thank you.
Thank you only for this insightful presentation from coming webinars. Please visit utrade.com.sg. Once again, thank you for joining us tonight and enjoy the rest of your evening.